这个本儿真的好难。今天我把
It's really hard to break even. Today, I showed my stocks to an experienced investor. He told me, get rid of it, cut your losses. When he said that, I felt a chill in my heart. If I quit now, that means I've lost all my money and I can't break even. But if I don't quit, I might lose even more. Right now, I'm stuck between a rock and a hard place. I just want to break even. My losses have already reached 110,000 yuan. I have kids. Where am I supposed to make that much money to cover this gap? The speed at which I'm losing money in the A-shares market is just insane. My investments could be wiped out overnight. I can't even speak anymore. Just look at this. Yesterday, I lost tens of thousands. Today, I lost tens of thousands. I just want to advise everyone, especially those who love trading stocks, to be careful. I lost more than 9,000 today, and that's an entire month of salary gone. Honestly, men leaving me didn't make me cry, but this morning, when I opened my stock account, I couldn't hold back the tears. When you see others making money in the stock market, don't envy them. When you lose money, you won't even see the tears. Just to correct myself, I didn't lose 420,000. That was just in the morning. By the time the stock market closed in the afternoon, I had lost 485,000. I'm fully invested in 13 stocks, and only 2 didn't hit the limit down. Didn't they say not to put all your eggs in one basket? Well, my basket just flipped over. New investors really shouldn't get into this. I'm a perfect example. Honestly, I don't even know how I got through this morning. From the moment the market opened, I lost 100,000 right away. That was just the beginning. This morning, I was so shaken I didn't even know where my heart was. My thoughts were completely out of control. I can't even describe what it's like to be heartbroken. It's like I'm numb. I'm completely numb. I'm losing more than 160,000 right now. I honestly don't know how to face this.
I'm not just upset about losing money. I'm upset because society has pushed us to this point. People in the internet industry lose their jobs when they turn 35. It's like saying goodbye to the workforce. I tried starting a business, but it failed because of the pandemic. Can you help me? Besides trying to make a living in the stock market, what other way is there to support my family? I'm feeling lost, and the stock market has been too brutal to us. Now I just don't know where to turn. Maybe I'll have to start driving for a ride-hailing service. I never expected my stock trading career to end like this. I started with 580,000, but now there's less than 170,000 left. I've already lost 415,000. Just today, I lost 40,000 in a single day. My account is about to be liquidated, and after this, I probably won't be able to update videos anymore. The market is just too harsh.
On April 7th, China's stock market experienced an epic collapse. By the close, the Shanghai Composite Index had fallen 7.3%, dropping below the 3,100-point mark. The Shenzhen Composite Index fell by 9.6%, and the ChiNext Index dropped by 12.5%. In Hong Kong, the Hang Seng Index closed down by 13.2%, with the Hang Seng Tech Index plunging by 17.2%. A total of 4,430 A-shares fell by more than 10%, accounting for 98.44% of the 5,400 stocks being traded. Almost all of them hit the daily limit down. The market lost 7.5 trillion yuan in value in just one day, making it the day with the largest number of limit down stocks and the greatest loss in market value in history. This round of market crash was mainly triggered by the impact of a new round of high tariffs from the U.S., as well as China's retaliatory measures. On April 2nd, President Trump announced a reciprocal tariff on all trade partners, including a cumulative 54% tariff on Chinese goods. On April 4th, the Chinese Communist Party announced countermeasures, including a 34% tariff on imports from the U.S., and filed a lawsuit against the U.S. through the World Trade Organization. Ms. Hu works at a leading securities firm in Shanghai, told foreign media that this Monday could be summed up as busy and panic-ridden. She explained that her colleagues had been working overtime during the Qingming Festival holiday to deal with the challenges of the tariff war. Many of them arrived at the office at 7 a.m. on Monday to prepare for the first trading day after the holiday, but the market's decline still exceeded expectations. Ms. Hu said the company had previously estimated that the impact of the U.S. tariff hike would be comparable to the 2008 global financial crisis, but based on today's market response, the consequences may be even worse than 2008. She expressed concern that the Chinese financial industry, which is already on edge, might face even greater risks of layoffs due to this additional shock. Chinese investors were in despair, with many saying that they had never seen such a disaster since they started investing in the market. Mr. Song posted a video on Douyin saying,
"Why am I still upset about today's violent drop in A shares? It's not because of the losses. The stock market has risks, and we know the rules. What bothers me is that, despite all the positive policies, the economy is starting to stabilize, and the fact that A shares don't have systemic bubble risks. The Shanghai Index should only slowly climb towards 4,000 points. There's no systemic risk of a decline. But this time, the market hit us hard again. I don't want to blame ourselves as retail investors. What I want to express is that in such a crucial time of the US-China rivalry, a stable capital market is so important for our economy. Why, knowing that there would be a significant drop on Monday, didn't our regulatory bodies or relevant departments hold a press conference around 8 a.m. on Monday warning about the risks of a sharp market decline and managing the risks in advance? Instead, they waited until after 2:30 p.m., when the market had already plummeted. They finally issued an announcement claiming that a mysterious force had entered the market. As a seasoned business owner and small enterprise boss, we've been supporting China's economy with real money. Why is it that every time we face a critical situation, we feel like no one is paying attention to us? If A shares fall below 3,000 points because of a trade war, this 3,000 point curse may never be lifted.
A netizen from Sichuan posted in a group saying that he lost 4 years' worth of salary in one day, and with a credit card and debts totaling 400,000 yuan, he felt he couldn't survive. Many others were in a similar situation. Some were stuck with all their funds invested, others had margin calls, and worse, some had just sold their homes to invest in the stock market, only to lose both their house and money. Another netizen said, "The hardest part is for the stockholders. The clothes I wanted to buy, the gold jewelry I wanted, the car I wanted, none of it is happening. It all went to the stock market." China's stock market has long hovered around the 3,000 point mark and failed to break through a key resistance level for 17 years. The already fragile investor confidence quickly collapsed under the massive negative news. The US-China tariff war also triggered a global stock market slump. However, while the US stock market fell from its historic peak of 45,000 points, representing a high-level correction, A shares starting from the low level of 3,000 points fell even deeper. The CCP had previously tried to use the US stock market's decline to shift focus and stir up anti-US sentiment. However, this blowback came much faster and more fiercely than expected. Even more unexpectedly, as the market approached the close on April 7th, China's two major state-owned enterprises stepped in to stabilize the market. At 2:30 p.m., Chinese state media, citing authoritative sources, announced that the Central Huijin investment company was actively engaging in market stabilization operations. Just 15 minutes before the market closed, the Central Huijin company issued a statement, expressing firm confidence in the development prospects of China's capital markets. It stated, "We fully recognize the current value of A-share investments and have again increased our holdings in exchange-traded funds, ETFs. We will continue to increase our holdings and resolutely maintain the stable operation of the capital market." In response to the crisis, Chinese state media reassured investors, saying the sky is not falling. Central Huijin is stepping in and remains confident. However, such reassurances have proven ineffective. With the vast scale of China's stock market, relying solely on two major state-owned enterprises to stabilize the market is like trying to use a cup of water to put out a fire. Some netizens believe that retail investors should ignore what the government says and focus on what it actually does. Others stated, "Wouldn't a statement before the market opens have some effect? But now, with the sky already falling, does shouting make any difference?" Regarding the Chinese government's market rescue measures, William Xin, chairman of Chunshan Pujiang Investment Management, said that this support is not enough to offset the impact of the intensifying trade war. He said, "At this point, trying to buy cheap stocks feels like catching a falling knife, so I will hold cash until the situation stabilizes." Central Huijin is a wholly owned subsidiary of China Investment Corporation, a state-owned company established by the State Council of the CCP, often referred to as the Financial State-Owned Asset Supervision and Administrations Commission. Huijin is one of the national team investors supported by the CCP, tasked with stabilizing the market during turbulent times. Looking at previous instances, such as the 2015 stock market crash and the CCP's implementation of monetary policies in the fourth quarter of 2024, While these interventions can boost the market in the short term, they are unlikely to provide long-term stability. Why has China's stock market struggled for 17 years, lingering around the 3,000-point mark, while stock markets in countries like the US, India, and France have soared? Let's take a look at the number of stocks in China's market. The Chinese stock market is only 30 years old, but A-shares now number over 5,400, almost catching up to the 200-year-old US market. Since 2015, the number of listed companies has doubled. The rapid expansion has outpaced the capacity for capital supply, and the sharp increase in the number of stocks has led to the dispersion of funds, making it harder for indices to rise. In addition, many fundamental systems and regulations in China's capital markets are deeply flawed. These issues stem from regulators' lack of expertise and, in some cases, their collusion with capital interests. The lack of effective regulation, along with frequent violation of rules by listed companies, exacerbates market volatility and puts retail investors at a disadvantage. In contrast, the long bull market performance of the U.S. stock market is closely tied to its mature capital markets, efficient capital allocation mechanisms, and stable economic environment. Notably, after China announced a 34% tariff increase on U.S. goods in retaliation for the U.S. tariffs, President Trump threatened on April 7th to impose an additional 50% tariff on China, forcing China to retract its retaliatory measures. This brings the total tariff on Chinese goods to 104%. On April 8th, China's Ministry of Commerce announced that if the U.S. escalates tariffs, China will firmly take countermeasures to protect its rights. In fact, many Chinese scholars do not agree with China's tough measures. He Bin, a scholar at the Chinese Academy of Social Sciences, criticized China's approach on WeChat, calling it completely the wrong kind of retaliation, like, if you hit your wife, I'll hit my wife. He argued that the correct countermeasure would be to implement unilateral zero tariffs on imports from all countries. However, these criticisms were quickly silenced. The Chinese Academy of Social Sciences announced the closure of its Public Policy Research Center, and the center's website and WeChat account were shut down and canceled. President Trump's tariff war this time primarily targets Southeast Asian countries, imposing a 46% tariff on Vietnam, 49% on Cambodia, and 36% on Thailand. However, Southeast Asian countries, led by Vietnam, now have an attitude that sharply contrasts with China. Vietnamese leader To Lam spoke with President Trump and announced that Vietnam would lower the import tariffs on goods from the U.S. to zero. He also suggested that the U.S. should apply reciprocal treatment towards Vietnam. To Lam made it clear that Vietnam is willing to negotiate for zero tariffs, which was welcomed by Trump. U.S. Treasury Secretary Steven Mnuchin has stated that tariffs are negotiable and could potentially be lowered in the future. In contrast to China's hardline stance, Taiwanese President Lai Ching-te announced 5 strategies through a national address, stating that Taiwan would not retaliate with tariffs. Instead, Taiwan would negotiate for zero tariffs, modeled after the U.S.-Mexico-Canada agreement. Lai also proposed industrial support plans and long-term economic development plans, emphasizing new industrial cooperation between Taiwan and the U.S. Thailand and Malaysia are also seeking compromise, signaling that these countries are unwilling to bear the high tariffs for China's benefit. This starkly contrasts with China's confrontational approach, which further isolates itself. This global tariff war is likely to evolve into a precision strike targeting China alone, similar to the U.S.-China trade war during Trump's first term. At that time, China attempted to sidestep U.S. tariffs by using Southeast Asian countries and Mexico for transshipment trade and shifting production overseas. Clearly learning from past lessons, Trump has now focused on closing the loopholes in transshipment trade to prevent Chinese goods from entering the U.S. market through backdoor routes. However, while China's tough countermeasures show resolve, they have only intensified the tariff war. As Trump follows through with a 50% tariff increase on China, it will undoubtedly deliver a new heavy blow to China's economy and stock market. Given China's current economic backdrop, after the 2018 trade war, the pandemic, and the real estate market crash, A-shares may once again fall into the 3,000-point curse. As tariffs on China reach 104%, Chinese goods will lose almost all their competitiveness in the U.S. market. Export companies will face sharply reduced orders, evaporating profits, and even bankruptcy risks, particularly small and medium-sized enterprises reliant on the U.S. market. In 2018, China's exports to the U.S. dropped by about 20%, and with even higher tariffs now, the impact will be even more severe. Taiwan's central news agency analyzed that when the tariff rates between China and the US exceed 60%, trade between the two largest economies in the world will shrink to almost nothing. Decoupling between China and the US has become a major topic of concern. High unemployment and economic downturn are already critical issues for China. The intensification of the tariff war will exacerbate this trend, potentially triggering large-scale layoffs and business closures. The sharp decline in the Chinese stock market also reflects the public's despair over the economic outlook. Executive Director Lai Rongwei of the Taiwan Inspiration Association stated that China believes its measures to counteract the U.S. sanctions are essentially severing ties with other countries, leading China into isolation. He believes that Taiwanese businessmen and investors from other countries must stay away from China, as they might be trapped by China, that are lured in, stuck, and ultimately discarded. Faced with high unemployment and economic downturn, Lai Rongwei believes that China uses countermeasures to deflect attention, but this strategy does not help improve the political or economic situation. If China's economy continues to decline, it will destabilize society and increase the risk of CCP collapse. The China Aid Association's comments on China's stock market have pointed out that the root causes of China's stock market problems are the same as the deep-rooted issues in China itself: a lack of rule of law, freedom, and human rights. The CCP is eager to use power to stimulate and create false bubbles, enticing and deceiving the public into saving the market with their own money. This will inevitably lead to waves of suffering for the people.